The two big assets that I look in all of this is really obviously cryptocurrency and technology stocks, because they seem to be outperforming debasement more than anything else. They're in a log trend channel, which means that basically over time, if the cycle's extended, the price goes higher. And I think people don't really understand this mechanism because of what happened in the kind of stunted cycle of 2021, that we've kind of got the opposite of 2021 at play here, which is that time is being extended and therefore price likely gets extended upwards.
If you're debasing, the main standard of value in the world economy, then you're going to have real assets like gold, silver, precious metals going up, and you're going to have cryptocurrencies going up at the same time. So these are the hedges against this long-term monetary debasement.
Raoul begins by addressing the big question on everyone's mind. When does liquidity peak? His best estimate, based on a blend of business cycle indicators, bond market volatility, and commodities like oil, points to March of next year, right around the first quarter of the calendar. That's important because it means we're still at least 6 months away from the liquidity cycle topping out. This extension matters.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Your best guesstimate right now of when liquidity peaks, is it Q1? A bit longer? I'm in the camp of Q2, but obviously it's probabilistic and it can change, but it's not this year. And
no, it's not this year.
That's a big important factor for markets.
Yeah, it's in my view, it's at least 6 months away. The estimates we came up with, we use leading indicators. Those leading indicators are based on factors like what the business cycle is doing, what's happening to things like oil prices, what's happening to volatility in the bond markets, a number of things. But that actually comes up with the latest figure that I saw was March of next year. So it's pretty much, close to where you're saying about that sort of time frame. That's what I would think. Now it may be extended by a number of factors, but that's what I think the cycle is pointing to.
Yeah, I do too. And what's really interesting to me is then go back to asset markets. The two big assets that I look in all of this is really obviously cryptocurrency and technology stocks, because they seem to be outperforming debasement more than anything else. They're in a log trend channel, which means that basically over time, if the cycle's extended, the price goes higher. And I think people don't really understand this mechanism because of what happened in the kind of stunted cycle of 2021, that we've kind of got the opposite of 2021 at play here, which is that time is being extended and therefore price likely gets extended upwards.
Yeah, that makes sense to me. I think that's, at the end of the day, we should be investing more and more in liquidity sensitive assets. I think that makes sense.
The dollar's still fundamentally strong and is gaining as the world's reserve currency, but its purchasing power via debasement is actually decreasing.
Yeah, absolutely. And I think, what could it weaken or strengthen against? Well, if you look at, I think the yen is, my view is I think the yen is deliberately being held down. I think that the Chinese yuan has to weaken against the US dollar in some form.
Yeah.
And I think that if you look at the European units, I think the whole fiscal backdrop is so ugly that I can't see why the euro should strengthen particularly against the dollar anyway. So, there may be a case for some of the emerging market currencies picking up, or the Aussie dollar cyclically. I don't know, but they're tiny in the context of things. On the other hand, if you're debasing, the main standard of value in the world economy, then you're going to have real assets like gold, silver, precious metals going up, and you're going to have cryptocurrencies going up at the same time. So these are the hedges against this long-term monetary debasement. And as I know you keep saying, there's a trend here and there's a cycle. The trend looks, compelling. The cycle, we may be coming to the end of it, but, cycles go up and down. If you start to look at how stablecoins operate, typically, you could make a case, and in fact, I've sort of argued negatively in one regard, to say that, you know, a big growth in stablecoin could actually dent bank credit significantly, because actually a stablecoin is a lot more, or a stablecoin issuer is a lot more constrained than a bank. And if a lot of funds move from banks into stablecoins, you're not going to get credit growth, which is, you know, clearly a possibility. But then you've got to think about it from the other side, is that actually it's a wonderful source of credit for the Treasury. And so this is what you're going to get, is much more public sector led credit growth via the stablecoin conduit. And it's really an opportunity, in no other words, for governments to print money.
Gold has been an interesting market. It kind of does what it's supposed to do right now. But what we found is gold seems to be highly correlated with financial conditions, not real rates and all the other things it was linked to. But it now seems to be pretty much real-time financial conditions. So, you know, it's been in this kind of wedge pattern recently. Let's assume that the dollar weakens a bit more from here, rates come down a bit more. That'll break out gold, because that's the majority of financial conditions, which kind of leads everything we found by about 9 months. So gold has become really interesting to watch, and for me is now quite explainable. It goes from periods of being explainable to not explainable, but you know, that pattern in gold I think is a important one. I know you look at gold as well.
Yeah, no, I think I endorse that. I think that if you look at real interest rates and the gold price moved very closely together for a long time, and then until they didn't, and they didn't basically from 2022 onwards. Now you can argue that was a lot of people say, well, that's because of the Ukraine invasion. That was because basically people got disillusioned with the dollar. They wanted a safer asset. That may be the case. I don't think that lines up exactly. I think what's the bigger driver is that was really the period where that was the time when you saw the beginning of this monetary debasement. So gold basically began to be moved much more by monetary factors, by the flow of liquidity, and a lot less by essentially the cost of carry interest rates. So I think that's the you know, people are buying gold as a protection, as a monetary hedge now, in the same way as I think a lot of people are buying. I mean, people bought Bitcoin because they didn't really know why, but they bought it. But I think now you're getting people who are buying it as a monetary inflation hedge.
What about the Federal Reserve? Raoul digs into their balance sheet and liquidity management. While some analysts fear a liquidity cliff from Treasury general account rebuilding or reverse repo drawdowns, Raoul isn't convinced. He argues the Fed is actively managing liquidity to avoid shocking the markets. And when you zoom out globally, the backdrop is even more supportive. Europe is easing.
I'm not bearish on liquidity over that time frame. No. I think that there are a number of questions that people will raise, and I think one of those, and I'm going to show you another chart, hopefully if this one works, is what's happening to the Fed balance sheet. So that's number one. And this is looking at a concept that, you know, I call Fed liquidity, which is the thing that I came up with, you know, when I wrote that book, Capital Wars, which is looking at, you know, the various components that the Fed uses to get liquidity into the system. Now, that's clearly an important element. It's not the whole story, but it's an important element. And what this is basically showing is that if you look at the projection period, on paper, the growth of Fed liquidity falls and goes negative. And the reason for that is if you come back to the underlying ingredient, which is US bank reserves, this chart is showing our projections through year end of US bank reserves based on...
Yeah, everyone's getting really caught up on this because they're like, the reverse repo is empty, and therefore, if you rebuild a TGA, you've got a massive liquidity shock. Yeah.
So, I mean, the question is, number one, will they rebuild the TGA? Well, okay, if you look at the quarterly refunding announcement, it says they're going to go back to 850. Well, I would be staggered if they get there, because to take that amount of money out of money markets would cause the repo spread to spike. And I don't think they want to do that. There's every indication they're trying to manage the repo spread. So I don't buy the fact that they're going to put it up. Even if they do put it up, you can find other ways of injecting liquidity, as we said, through Treasury QE or getting the banks to buy debt. So I think there are other ways around it. But, you know, what that chart is trying to illustrate is that the dotted line the red dotted line is my estimate of what adequate reserves are, minimum reserves in the system. And it looks as if there was that step change back last August when you got the change in the stress test rules. But basically, what's happened to bank reserves through this year is they've very closely hugged to that dotted line. And I think that's deliberate because, as we know, the Federal Reserve controls bank reserves in aggregate completely. And I think that's what they're targeting, amongst other things. So to see that drop off, which is the TGA rebuild prospectively, I just don't buy. I don't think it's going to happen. So I think that number one is you've got still pretty decent Fed liquidity. And everything that I hear Scott Bessent say and what I see the Fed doing is they want to manage that liquidity. They don't want to pull the rug from the markets. Why should they? Number one. I think if you look at offshore markets, or in other words, international markets, I think that Europe continues in the groove it's been doing, which means adding more liquidity. They're going to have to do that anyway. And I think all the moves are towards more ease in Europe. Japan, I think, follows because they want the yen to remain soft. And China is embarking on a major monetary expansion. So as far as I can see, the liquidity background still looks to be pretty benign over that time frame.
What's interesting is those of us who've been around a long time, we grew up with the Eurodollar market. The Eurodollar market was the wholesale funding markets of the dollar, but that stopped at like the big Japanese banks, the European banks and stuff like that. And then you had to get access to it, and it was restricted down to others. It was hard to get hold of dollars outside of that, but that was the big dollar funding market. What stablecoins essentially is a fractionalized Eurodollar market down to individual level. So it means you can be in any country in the world and get access to dollars, which is an extraordinary thing. And so what you're doing is spreading the dollar and the issuance of bonds and the holding of bonds down to individuals all around the globe.
Yeah, I think it's a revolution. I think you can see why it's so important, given the sort of sudden change of heart by the Europeans, who were sort of dragging their feet hugely on some equivalent euro currency, and now they're basically going full steam ahead.
And are they going to do it via the central bank digital currency route, or are they just going to let the open market just build to try and spread demand for euros? Because
I think given the fact it's Europe, it's got to be the central bank route. They're not going to let the private sector get in there, but that's what they should be doing.
Yeah, and let's see whether there's actual demand for euros on a globalized basis. It feels like it's a dollar world, and it's the US.
But I think they're running scared because they realise that they could be wiped out or smothered, crowded out, in fact, by dollar stablecoins.
And even your chart of showing the amount of money piling into the US shows that crowding out is happening. And that's what we're seeing in the UK and the French bond markets, essentially, is there's not enough foreigners who want to finance other countries' debts. We're seeing, whether arguably maybe in Japan as well, there's not enough demand because everybody would rather finance the US. Yeah,
I think absolutely. I think that's the reality of that chart. But it's been the reality for the last 15 years. That there's a lot of money that has flowed into the US because the US is the bond market. It's global collateral, and they've got on top of that the added icing on top is the tech sector.
So, final question for you. So, do you think the rate of debasement or the increase in liquidity, the rate of change increases from here, going into this whole big, large refunding period? So we should see a spike in all of that, or is it kind of more as steady as she goes?
The way that I think about it is to go back to this chart, which is looking at the ratio between debt and liquidity. And what this is really saying is that over the long term, financial stability demands a stable debt liquidity ratio. This is for the advanced economies. If you get debt growth, and I think debt growth is, let's take the US as a decent benchmark, debt growth is likely to be growing at something like 8 to 10% per annum, or that sort of magnitude. Then I think what you've got on top of that is equivalent liquidity growth, because you need a stable debt liquidity ratio. So liquidity has got to grow at pretty much the same rate. Now, what we know is that a lot of those projections, and I tend to use numbers that come from the Congressional Budget Office for want of any other source, they give decent long-term projections. The problem with the CBO numbers is they don't take into account recessions. And we know that recessions basically lead to big deficits. And in the last couple of recessions, the US deficit's blown up by 4 to 5 percentage points of GDP. So you could be seeing actually a lot faster potential growth of debt anyway. So I think that these figures are of sort of 8 to 10% minimum, minimum figures. And that's what we ought to be thinking about. So, in that case, you've got to choose assets that are likely to give you that sort of return over the medium term. And there's not that many around. Certainly bonds don't do it.
Finally, Raoul ties this into a structural view. Over the long term, advanced economies require a stable debt-to-liquidity ratio. With U.S. debt growing around 8 to 10% annually, liquidity must also expand at a similar rate to maintain stability. And if recessions hit, deficits spike even higher, forcing even faster liquidity injections. That creates an environment where investors need to target assets capable of delivering 8–10% plus annualized returns. Bonds don't meet that hurdle, but crypto, tech equities, and scarce assets like gold just might.